So basically today we're going to try and explain how the market works. But basically maybe let's start, from the market structure, right? So while for stock trading, the importance of market makers is lower. For option trading, the majority of the transactions are executed by market makers. And also we need to know that 90% of options expire worthless. So also this has an impact on price movement. So if we look at this slide, this is really typical option chain that you would see in any of your broker platform. And the reason why the majority of transactions are executed by market makers is because if we now look at the chart of Google, we now have dozens of expirations and hundreds of strike prices. And if you look at the American market, we have thousands of companies. So imagine that there would never be another trader or another investor on the other side of each of these transactions because there's like thousands of options contracts, right? So that's where the market maker comes in, and that's where we see the importance of market makers. And for those really who don't know what market makers are, really they're institutions that provide a bid and ask price. And we can use those bids and asks that we see on our broker platform to then buy or sell stocks, options, or futures, right? So they're there to provide liquidity to make sure that the market is functioning efficiently and we can always sell or buy a security at any given time. But the most important part is really to understand, okay, so like we know what the market makers are, how do they make money? So as we said, there's never going to be a buyer or a seller on the other side of the transaction, especially if we look at options trading. So by us buying or selling, that means that somebody else on the other side is taking on a risk, which is the market maker. So they are not in the business of making money from directional trades. They are making money from the increase in option volume. So they make money from the spread between bid and ask, right? So by knowing that, this is a very, very important concept, then we can go back to the basics of options, right? So if we buy a put option as an investor, we're basically buying an insurance that allows us to sell a stock at a higher price if the price were to fall. So we are now like really protecting ourselves from a potential downside in the market, right? If we buy an option, we are long option. And if we sell an option, we are short option. So as we discussed, on the other side of the trade, we have a market maker which is taking the opposite side. So when we are long options, then the market maker is short options, right? And vice versa. So for every option contract, if you are trading stocks, the market maker has the obligation to buy from us 100 shares of the underlying stock at the strike price at expiration, right? So if the stock continues to fall, then we are able to then exploit our put option. So in this case, we see that we have a put with a strike of $40 and the market price is $30. So we can now, instead of selling at $30, we can now have the opportunity to sell at $40. So our profit in this case would be $10 compared to where the market price is. But again, the market makers, they're not making money from the direction of the trade. They're making money from the increase in trading volume. So if a lot of investors think that the price of a stock, in the example of Tesla a few weeks ago, continues to fall, and they start buying a lot of put options that because they are worried that the price of the stock might go down, what does that mean for the market maker again? Well, if the price continues to fall, then all these investors will want to exercise their put options because they could sell the stock at a higher price, which could potentially put the market maker in a very tricky situation because they have the obligation to then buy back these shares at a higher price. So by selling the put option, then the market maker is really selling the insurance and is now forced to buy back those shares, prices that are much higher than the market price. And if a lot of investors are buying a lot of put options, then they might have to buy a lot of stock at these prices. And therefore, that would increase their risk and their performance. So essentially, what the market maker does is doing something called delta hedging. So delta hedging is kind of like their own protection. And it's a really complicated concept that involves understanding how Greeks works, how option works. And we're not going to go too much into the details of it today, but really, in the simplest form, it means that the market makers is always hedging its portfolio, making offset trades that will mitigate their risk.